Hi everyone, I'm looking at interest rates in my video today and why I believe interest rates should be heading lower over the next 6-9 months, and I'll explain to you in this video why. Before I get started, why do I pay attention so much to interest rates? I'm a commercial real estate broker. I'm also an investor in real estate, and very important for me to really pay attention to what's going on with interest rates and kind of know where it's going so I can advise our clients properly. So in this video, I'll be looking at 4 key indicators. The first one is going to be the EuroDollar Futures. The EuroDollar Futures market is really all the US dollars that are deposited in commercial banks outside of the US, and this kind of gives us an indication of where the interest rates are on a 90-day window. And currently, if I look at the EuroDollar Futures where it's at, it's giving us a pricing for interest rates on a 90-day window of around 5.09%. But if you go forward to see where the market is pricing interest rates for June of 2023, it's around 5.17%, meaning that the market thinks that interest rates will be kind of staying similar over the next 6 months. But the market is pricing the Eurodollar futures for December 2024. It's pricing it at 3.65%, which is significantly lower than where it's at now, meaning that the market thinks that the US Federal Reserve will be doing a pivot over the next year and a half. All the other central banks will eventually follow as well. So that's where the Eurodollar futures is telling us that we should be seeing an interest rate drop over the next, let's say, year and a half latest. If you look at another indicator that I'm looking at right now is the US Federal Reserve. If you look at the US Federal Reserve, they started this massive hiking cycle this year. It went from 0.25, currently it's at 4.5%, the Fed funds rate. If we go back the last 25 years, during the dot-com crash, when they were doing the hiking cycle, that led to recession, and then obviously it then gave a lowering of interest rates. The same thing happened right before GFC, 2004, 2005, 2006. The Federal Reserve was increasing the rates. All of a sudden, that led to the housing crash of 2007, 2008, which was the global financial crisis, which led to GFC. Then after that, the rates had to be lowered again, and we saw lower interest rates. And the same thing happened right before COVID, 2016, 2017, 2018, 2019. We see the Fed funds rate was going higher and higher and higher. Then all of a sudden, we had this COVID issue in 2020. They had to lower rates again. Obviously, that created also lots of inflation where they did the printing of monies, and we saw this the current inflation issue that we have. It all started in 2020, really. So basically, that as well is telling us that the Federal Reserve increasing the rates in this market right now, where we're seeing already issues with a potential recession, is an indication that when we do have the recession that's potentially coming in 2023, then the rates will have to be lowered again, which will be good for real estate investors. Obviously, it's not going to be good for the general economy. Why is this also a bad idea? If you look at what's going on with the 2-year and the 10-year Treasuries, the 2-year and 10-year Treasuries are kind of indicators of where the economy is. The fact that today the 2-year Treasuries have higher interest rates than the 10-year Treasuries is telling us that basically, typically, if you listen to all the economists, this is an indication that basically the yields are reversed. It's a yield inversion. All of a sudden, what this does is that, meaning that for the major investors, that they're better off basically doing short-term investments, putting it in Treasuries instead of long-term investments. Then this takes cash out of the market into short-term investments, and this means that there'll be less money available for growth stocks, obviously a bit less money available for real estate. Once this thing is re-corrected, where the 2-year Treasuries go lower rates again, then we'd see this money come out of these Treasuries and back into the market, back into real estate, and back into growth stocks and so forth. But obviously, right now, the way we're at right now is that with this yield inversion, we have a very problem for potential recession, and the US Federal Reserve is still increasing rates. So obviously, this will definitely give a recession potential for us. And when a recession comes, we know what follows is then going to be the rates going back down again. The third indicator I'm looking at is the ISM indicator, which what the ISM is the ISM Manufacturing Index. It's a US index, which kind of gives an idea about how the US economic activity is behaving based on a survey of purchasing managers at more than 300 manufacturing firms. So what this is telling us right now, the ISM is below the 50 mark, which is negative. It's not as negative as, let's say, it was, let's say, during COVID, or let's say during GFC, or during the dot-com crash, but it's still negative. It's still an indication that the economy in the United States isn't very strong. What that does, obviously, is that the US being such a big important factor in the world economy, this has a significant impact afterwards to Canada, also, of course, Europe, and so forth as well. So ISM is the third indicator that's kind of telling us that we're in a negative environment. What this means as well, if we look at one more indicator, which is going to be the Chicago PMI. Chicago PMI is an indicator that kind of is telling us that if you look at the Chicago market, which is really the third biggest market in the U.S. As far as GDP is concerned, after New York and Los Angeles, is right now at the same levels that it was at really back in, let's say, similar levels where it was at during 2000, the dot-com crash of 2000, of course, GFC as well, and also during COVID as well. So again, it's negative. We see from the charts here clearly that's a negative cycle, meaning that all these indicators what they're telling us is that potentially things aren't looking great for the economy over the next, let's say, 3, 6, 9 months. What this means that if things do proceed for a potential recession, then we would see the U.S. Federal Reserve stopping these rate hikes. When they stop the rate hikes, or potentially also pivot downwards, as the EuroDollar Futures was telling us, then the other central banks will follow, which would be kind of helping us get these interest rates more stabilized. So if you like this kind of content, follow my channel. I focus a lot on commercial real estate and also on interest rates.